The mortgage process is unlike any other financial service you might obtain in your life. While many financial services, such as checking and savings, credit cards, even automated investment accounts, might have a instant process, this is not the case for a residential mortgage, and I'm going to explain why. Why isn't the case? Well, for two main reasons. Reason number one, when a mortgage transaction is completed, the bank is typically departing with a large sum of money on your behalf. And if a risk analysis is not carefully rendered, this can lead to the bank increasing their odds of taking a loss. Reason number two is perhaps more important and one many applicants don't understand, and that's that we have a subsidized housing system with mortgage backed securities, and that means that mortgages must meet a certain criteria to be purchased behind the scenes. And this plays a role in stabilizing our housing economy in the United States. If mortgages are not up to standard to be purchased by Fannie Mae and Freddie Mac, this would actually increase borrowing costs and raise rates for all of us and possibly destabilize our housing market. So what? What does economic stability have to do with you? Well, it actually has everything to do with you as the borrower. Yes, you, meaning that you will need to have your financial house in order when applying for a mortgage and avoid certain pitfalls that some prospective home buyers get denied for. My name is Jeremy Stebbins. I'm a licensed mortgage broker with the Mortgage 101 team. And in this video, I'm going to list the 5 main mistakes to avoid so you can get your mortgage approved. Okay, starting at number 5, avoid long gaps in employment. Sometimes a borrower might appear to be very qualified if you take a snapshot of them today, but the underwriters want to peel back the veil and look at the last 2 years of your employment. They want to understand that your current employment is stable and likely not going to be short lived. It is often a surprise to borrowers that a gap in employment can become a reason for a denial, in spite of the fact that they are earning maybe good money today. But fear not all gaps in employment are a reason for denial. In fact, the vast majority of employment gaps are most likely allowable if there's a sensible explanation, as well as supporting documents to explain that. Number 4, avoiding unseasoned business income. Similar to the concern around employment gaps, underwriters want to confirm that income is stable over a 2-year period. For self-employment, for self-employed owners or business owners, this means at least 2 years of tax returns, proving your self-employment income over that time. But don't be afraid to talk to your loan officer about it, as there are some exceptions that allow you to provide as little as 12 months worth of income. Also, talk with your mortgage broker about alternative options. There might be alternative non-QM, non-Freddie, Fannie-backed mortgage programs that would allow for a shorter income history. All right, reason number 3, non-credit qualifying credit score. This can shut down a mortgage application pretty quickly. It is important that borrowers demonstrate reasonable responsibility with borrowing money and paying bills on time. In many cases, it is important to have a credit score of at least 620 or higher, to have a few options on purchasing a primary residence, but even higher scores in the 7 or 800s could possibly save you thousands on better pricing on interest rates, as well as lower mortgage insurance premium costs. It's important to be proactive about your credit score, even if it has suffered. Talk with your lender about a plan to get the score back up, and also talk with them about potential alternative programs that might have more grace on lower scores, such as manual underwriting. Okay, reason number 2, avoid insufficient funds and reserves to close. As elementary as it may sound, you need to make sure that you have enough funds to cover the down payment and closing costs. This is one of the most important reasons you should allow your lender to do a detailed pre-approval. A prudent loan officer should always be concerned about if there's enough funds available at closing and should never assume someone probably has enough. But if you are concerned about not having enough funds to close, talk with your lender about this. There might be down payment assistance programs, gifts funds, seller concessions, or even a combination of these things could be deployed to get you there. Okay, reason number one, avoid not having enough income. Nothing kills the mortgage loan application as quickly as not having enough income. Why? Because underwriters want to confirm you have prudent debt to income ratio. Generally, underwriters want to confirm your existing debts plus new proposed mortgage does not surpass 50% of your monthly income. This doesn't mean you need to be a gazillionaire, but it does mean that home ownership typically favors medium to high earning borrowers. Anyone who tells you otherwise is either ignorant or they're afraid to be blunt. But if you have concerns about income, don't disqualify yourself. Talk to your lender and get feedback on what you need to do to obtain a home one day. Obtaining home ownership is not a pass-fail test. It is an educational journey where you slowly assemble the path over time. Thanks for watching this video. My name is Jeremy, and I am a licensed senior mortgage broker with the Mortgage 101 team. And if you want to learn more about the mortgage process or possibly even get pre-approved, feel free to DM me today. I hope I invested in your homeownership journey through this viewing, and please like and subscribe so I can keep making more content like this. Thank you.